Scott, would you fade this move? I can see in the short term, a lot of people might be saying we're stepping down here. We're going from 75 to 50. We've seen so-called peak Fed hawkishness. Others might be looking at this and say, hold on, this economy is going to turn around. They're going to keep taking through weakness and might stay there through the rest of 2023.
Jonathan, I think that, and as I often talk about the tension of being a trader versus an investor. And look, we're in a period of time right now that is seasonally strong for risk assets. And so I wouldn't necessarily fade this move right now. I think that, through the end of the year, we're likely to continue to see people looking for risk-on opportunities. But the second part of this is, the message is loud and clear. We're going to keep raising rates until we get price stability, and that's probably going to go into 2023. And at some point, this rally will fade, but I don't think it's going to happen right now.
What do you think will trigger it, given the fact that we are probably going to get some sort of tapering off in the pace of rate hikes, certainly by early next year?
Yeah, I think that, when you look at equities, and you look at the multiple that's attached to them, you either have to say that you have earnings growth that's well above what you would expect in a recession, and therefore, the multiple is good. I think that the reality is that earnings at best are going to be flat, and probably we'll see, S&P earnings drop to something like $200. When you look at recessions in history, a 15 times multiple on $200 would be what you would expect. So, that gives us room for substantial downside. And, that kind of a scenario that I'm talking about looks very similar to the downturn we got in 2001, 2001, after the internet bubble faded. And so, I think that we ultimately will have to find lower lows, but I think the catalyst will be earnings.